Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is June the 22nd, 2023. It's now 3:24 p.m. Central Time, about a half an hour left in the trading day and the bond market sales day. Got to take a look and see what's been going on today. It was a pretty difficult day so far for the mortgage-backed securities, seeing us down at one point over 40 basis points, really losing some of the gains that we had the last couple of days. So let's take a look and see what is going on here. Here's the big news is that there have been 2 days of interviews and testimony from Jerome Powell, the chairman of the Federal Reserve Board, and really just paying very close attention to the verbiage that he's using, really talking about that they're just not seeing inflation coming down fast enough, although they are seeing it come down, and that the job market is stronger than they would like to see it. Again, remember that months and months ago, I mentioned that the Fed actually said they want to create pain. They want the markets to feel pain in order to shrink the markets. That happens in two ways. Number one, you feel pain because of the lack of liquidity and the increase in interest rates on things like your credit cards, home equity lines, new auto sales, and things like that. Well, mortgages also. And also because the slowdown in consumption. So when people have less money and they tighten it up and they push interest rates higher, people have less money to spend. When they spend less money, let's say that I always talk about the Snickers bar. So let's say that less people are buying Snickers bars. At one point, the company that produces Snickers doesn't need as much employees, as many employees as they used to have. And the chocolate factory that produces the chocolate that is used in Snickers bars don't need to have as many employees. They don't need as many employees because they're just not consuming as much of the product. When that happens, you have layoffs. So the slowing down of the economy at one point, the slowing down of consumption at one point allows the employers, or really causes the employers, to lay people off and stop hiring. So they want to squeeze the market so tight that it bleeds over to layoffs and difficulty in the employment world, in the employment scene. And they're just not seeing that yet. So they're saying, look, I guess we just have to even squeeze tighter, which is what we're starting to see. The markets really don't like to hear things like that when it comes to the bond market and mortgage-backed securities. Today, we're down 42 basis points. Again, not something that we want to see. We really want to see the opposite in order to really start making some gains back into the market. 10-year Treasury is up 7, now just under 380. You can see that we had a couple of good days here, but unfortunately breaking below the 25-day moving average and the Fibonacci level here, really kind of floating around down here now to where these two will become ceilings of resistance rather than floors of support like they were in starting today. So what does that mean for our mortgage interest rates as of this moment? Let's go to the scenario here. The Brent Bruce Daily Very Well Qualified 30-year fixed conventional home loan with an 800 FICO score, 25% down on a primary residence, single family residence. Okay. Now, I'm pretty happy to see this. I was kind of surprised to see us hanging at that 6.875% with a little bit of a credit, $162. And again, the loan store is definitely leading the way. 11 mortgage to get to that 6.875 is costing $763. Flagstar is costing $961. Sierra Pacific is costing $1,500, and United Wholesale to get to a 6.875 is costing $1,555. But United Wholesale likes to use that 6.99 number, as you can see here, for a cost of $79. So staying in that 6 handle pretty easily there. Look at the 5.99, still now costing over 2 points to get to that 5.99. So again, buying down points is pretty effective today. You can get down to a 6.5 for about 1 point. Something we need to look at, asking our sellers to pay for a point or our buyers to pay for a point in order to get a lower interest rate. Now, again, this is based on a very well qualified 30-year fixed conventional home loan. Those are the parameters that we're looking at right there. Next thing that's going to be coming up that we want to pay attention to now that we've gotten through the Fed speak and the announcements and the interviews from the Fed chairman, Jerome Powell, is going to be the personal consumption expenditures report that is coming out next week. We'll be paying close attention to that number there. I think it's next Friday. That'll probably be the next market mover. I will keep you posted. We'll talk to you again soon. Make sure that you like, subscribe, share, hit the notification bell up in the top corner. We'll talk to you then.